Hey, fellow traders, this is Austin. It's Tuesday, February 28th. We're wrapping up the second month of 2017. Two down, 10 to go. Been a very quiet past several days, week and a half or so on the volatility front. Actually, volatility's been waning. It's been dropping, drying up, getting quieter for the past few weeks. And you know what comes after that, and you know what's straight ahead of us here in the not too distant future. High volatility. That's always the resolution. One extreme market condition almost never resolves itself with middle of the road and then later on the opposite extreme. Almost always, if you're at high volatility or if you're at low volatility extremes, abruptly you're going to get to the opposite overnight. Right away, something's going to take place, and then over a period of time, you'll get to that middle line, whatever. So that's what we have recently. Very quiet markets, all of them, not just stocks, but crude oil, currencies, bonds, everything is the way it is. Now, I'm going to show you a price action only tactic that'll tell you with a high degree of probability if you are in a trend day situation in the afternoon, past noon Eastern time, or not. Okay, and those conditions did not exist here in the past several days. So I'm going to go backwards in time to when the markets were more expansive, more normal ranges and so on, and show you something to look for. This is specific to say from noon onwards to late afternoon trading to catch some high probability trend continuation moves, or to know when it's probably going to be a reversal day or a range day. So let's check it out. We can find some good examples here mid-month. Just a couple of weeks ago, of course, this is the S&P 5-minute chart. And I'm going to put the open range on because I always do. It's always there. And, of course, the coil markets roadmap intraday profile levels. That's what they are. This is 90% probable to be hit any given day. 62% probable any given day. 50% probable to be hit any given day. So market opens up, trades here, holds itself contained, and then afternoon it takes off and goes up. Here's the key. Prior to noon, so you figure out where noon Eastern time is, and this is if you're looking at the markets past noon. This does not work prior to noon Eastern time, all right? Where was the peak high or low? Okay, and so the peak high was here prior to noon. That being the case, if the market breaks above that, past noon, at or past noon, then it's likely going higher. This is a very high odds situation. So the market indeed traded above that point, and you can see where prior resistance became support and then traded upwards. In an afternoon situation, that is money almost every single time. Of course, there is no such thing as every single time, but almost every single time, whatever the morning high is, if that's exceeded from noon or afterwards, there's a continuation to follow, and that's just the market breaking through and continuing up. Same situation next day on Valentine's Day. There was the peak high in the morning, and then the market just kind of traded in a range. I'll just put the open range on here because, well, why not? And so there it is. And you can see they hung around they chopped both sides of it, hung around both sides. They hit the 233 here, fulfilled that 90+% probability situation. Traded up, and you can see where this met resistance. You can see that's clearly congestion there. It was clearly a pivotal point in the market, and then they pushed higher. The trade of the day was there, right? This is, like I said, very high odds, all markets. And the same thing to the downside. If they're trading, we don't happen to have one here in stocks because lately it's been a downside market, but whatever the case may be, here was the morning high around 11:30. Let's see. Well, we can make a case for two of them. This is one of those. And so here was that 11 o'clock high, and that's kind of the cutoff. We could even go to 11:30, which is about here, right? So there are those two marks. And then, and of course, they hit the roadmaps like they always do, et cetera, et cetera. And then we can see this high. And they came up into noon, and then they came back and they based there. And it's no surprise that certainly no surprise to me that they based there. I've been seeing this for forever, years and years. And depending on which zone you use, it's the same results. You're going to get buy signals from here somewhere, and there's your afternoon trade. When that does not happen, okay, now I just showed you 3 scenarios in a row where that happened. Let's take a look at some scenarios where it does not. Alrighty then. Take a look at yesterday. Open range, because it's just a force of habit. Put that on every day at 9:35 for stocks. Here's the morning swing high up here. It's kind of a mess. Morning congestion, put it that way. And it never really did. The market never really did break out. Just a little bit. You can see where it came in and it held until just about to close, till 3 in the afternoon, and then it went up, that little blip. But there was no penetration here until late in the day, when that's just garbage time. Late in the day, these are just traders settling up the ETFs that they're day trading. So anything that happens past 3:30 right now in these low volatility situations is garbage. Afternoons are dead. Morning high, unbroken, actually contained, and then they turned it over, and the morning low, which was here, that got taken out, and you can see they held that resistance for the rest of the day. Didn't go anywhere. There was no range. There was just whatever econ news or breaking news created that little blip. There is all that there was. And so when you set up your markers by 11:30, pretty much, and your chart looks like this. Chart looks like this at 11:30. You're like, okay, whichever side they trade is probably which direction it's going to go. This is applicable to any market, any symbol, any time that you're active from noon onwards. Okay, now there may be similar situations with different periods of time, different hours, in other words, in currency markets. Might be something to it in gold or crude oil. I have no idea, nor am I going to find out. If you're interested in finding out, then check it out. Go back through and look at swing highs and lows for periods of time and see if you find patterns where they're broken. I can tell you that in the U.S. pit session trading periods, for all of the symbols that I've mentioned above, this holds true, whether it's soybeans, whether it's crude oil, whether it is bonds, whether it is stocks. If you're trading these U.S. market hours, this is a universal law. Almost every time when you get a break above the morning swing high, peak high, let's use that term, break below the morning swing low or peak low, trough low, then you're going to get trend continuation to some degree. How far is unknown. How big a potential profit, no idea. It's just that the odds of probability are there's going to be some continuation, so it's safe to trade that way in the afternoon. Hope this helps. Looking forward to working with you in March, and as always, best trading wishes.